Hi, I'm Les Mail. I'm Head of Sales for Nasdaq Commodities in Europe. And welcome to this second instalment in our series of Nasdaq 4 Minutes. Last time we met, we explored the Nasdaq offering in the German electricity market. And I want to cover that again a little bit more today, but delve deeper into the renewables area of the market, particularly focusing on volumes, liquidity and volatility. We've already discussed the strong track record of Nasdaq and how we're building a pan-European power market, building and transferring our expertise from the Nordic power to that of other European power industries, notably Germany. We know that Germany is Europe's largest power consumer. Approximately 20% of all European demand is driven by this intensive industrial base. But with a closure of old nuclear plants and a greater reliance on wind and solar, indeed, the renewables industry account for about 25% of all production. All this aids short-term trading dynamics, with liquidity concentrated on the front 2 years in the overall market. The resultant trading is still strongly bilateral, but now with a growing clearing base and futures market. Against that backdrop, the market is faced with more regulatory challenges in the shape of EMIR, REMIT and MiFID. All of these have professionalised trading, but come with greater cost consequences of more reporting requirements, new margin rules and new capital charges. This has resulted in a greater awareness of risk and to the benefits of clearing, where we can mitigate down to one net cash position and handle multiple risk exposures. So what are we going to do about it? Well, one of the biggest challenges in the German power market is the growing share of production from the renewables energy. This and the fact that it's preferably fed into the grid whilst being heavily subsidised and with targets that are set to double in the long term. What has this meant for the German energy corporations who now have stranded investments in these conventional power plants? Well, they're struggling and profits have dipped over the last 3 years. The plants are now suffering their biggest ever crisis and there are closure applications for over 50 installations. The ever-increasing importance of the renewables sector of the German power market has relocated much of the trading activity from the long to the shorter end of the curve, particularly for the within-day and day-ahead markets. But the very nature of our weather causes fluctuations in the production of the renewable energy, and this increases the volatility in the spot and short-term markets. Couple that with the regulatory changes, we now have a very challenging arena for the traders. Nasdaq will address this trading shift by developing renewables power contracts, which, if you like, will fill the missing link between conventional power production, renewable energy prices and the trading market. In essence, bringing fluctuating renewables into the derivatives marketplace. Underpinning this new renewables contract are our core German power products. These have witnessed a remarkable 30% year-on-year growth. That's even against the backdrop of the exit of some financial parties. So as you can see, Nasdaq are committed to being innovative in its product design and bringing real value to market participants. I hope that this latest 4 minutes broadcast has shone a little light into the renewables impact on the power market, and we at Nasdaq will strive to keep you informed of our developments as we build a best-in-class offering for the market parties. Please visit our website where we will keep you informed of our developments or contact me for a meeting. I am Les Mail. Thank you for listening.